The primary purpose of this podcast is to educate and inform. The views, information, or opinions expressed by hosts or guests are their own. Neither the show nor any of its content should be construed as investment advice or as a recommendation to buy or sell any particular security. Security-specific information shared on this podcast should not be relied upon as a basis for your own investment decisions. Be sure to do your own research. The podcast hosts and participants may have a position in the securities mentioned personally through sub-accounts and or through separate funds and may change their holdings at any time.
Welcome to This Week in Intelligent Investing, where we examine timely and timeless investing topics to help you become a better investor. Enjoy authentic, unscripted discussion featuring Phil Ordway, Elliot Turner, and other thought-leading investors, brought to you by MOI Global. And now, here's your host, John Mihaljevic.
Welcome, everybody, to a new episode of This Week in Intelligent Investing. It's been a little while since we've had this conversation. So excited to have Phil Ordway joining us again. Elliot Turner, of course, as well. Phil, thanks so much for taking the time to just kind of sit down with us and take a bit of a pulse on where we are in the markets, in investing, state of the world, where you guys are seeing opportunities. There's a lot of different topics we can touch on. Elliot, what's on your mind?
Yeah, John, thanks. It's really exciting to have Phil back on the podcast. I know our schedule has been a little more eclectic than it had been. I really missed my every other week catch up with the whole crew, and it kept me fresh on lots of ideas that, obviously still looking at new ideas on a day-to-day basis, but getting these kinds of thought-provoking conversations and forcing myself to be in a position to prepare to bring my own thoughts with the amazing crew here. I feel like it's something that I've been missing, and I'm pretty excited to be back here today with the whole core team that has been doing this since really early in COVID. Great to have Phil back. I think some of the things I'd love to kind of revisit with the whole crew is the dominance of a few big companies, the benefits of business first in evaluating things as opposed to like focusing and caring about stock prices moving every day. It's something that everyone wants to be, but there's so many pressures that we face that might make it hard. And I'd be really curious to explore some of the evolution of the rate environment and what that means, where that may or may not present opportunity. Really eager to just see where this conversation goes, because I think it's been a nice format for us to have the panel that just hops around. So welcome back, Phil.
Thank you. It's good to be here. I appreciate you guys having me back. Sorry it's been so long. I've been busy and excited. I do miss this conversation with you guys too. It was good to catch up just now before we started recording. It's good to be back on with you. Hope everybody's been doing well. I do want to say, just at the onset, I obviously was everybody remembers back in the day, pretty circumspect about talking about specific ideas. It's even more so now. Nothing I'm going to say represents anything other than my own personal opinion, and even that'll be pretty topical and evergreen rather than something that's real specific. But yeah, I mean, as we were talking about earlier, I've just kind of been marveling in wonder earlier this year, particularly in the first half of the year, with things like, I hate to say it, but it was kind of a bubble in AI stuff, things that were just priced for never-ending growth and perfection. It was just wild to see the kind of second and third life of the meme stock mania, whatever you want to call that. I mean, it was just insane. I never thought I'd see something like that in 2021 when it happened the first time, and here we are 3.5 years later still talking about it. I remember when we had Spencer Jacob on the podcast, however many, that was probably 2 years ago already, and it's still happening. It's just completely bizarre to me. And I mean, now that I pay even a little bit more attention to interest rates and credit markets, at the end of last year, the market was expecting at least 150 basis points of interest rate cuts, and we just had the first 50 last week. We're recording this in the third or the fourth week of September, and we're just now getting into rate cutting times. And so There's a lot of really interesting stuff happening in that world, and it's definitely no shortage of crazy stuff going on. That's for sure.
Yeah, it's interesting. I feel like the market's still expecting the same degree of rate cuts on the year. It's just, as a lot of companies always say, it's back half loaded.
Yeah, that's true. I mean, I think we're down to, I'd have to look up the probabilities right now, but maybe 2.5 more is kind of the over under in the market. But with only 2 meetings left in the year, it's getting a little late in the game, so to speak. So I'd be, barring some exogenous event, I doubt we're going to get to 150 total for the year. And the other thing that I found really interesting is if you take relatively liquid markets and dependable futures markets that are out there, and you can go out at least a year and a half or 2 years. And this would be, if the markets are to be believed, which of course they're wrong all the time, as we were just talking about, this would be the first rate cutting cycle since the 1980s under Paul Volcker, where the bottom of the rate cutting cycle troughed out above 3%. Right. So most every other time that in recent history that you've had the Fed cut rates, they needed to go really deep, like below 2, below 1 even. And this time we're not even projected to get below 3, which is kind of interesting, right? And it's got all sorts of implications, and you can attach your own logic and reasoning or narrative as to why that might be. I've certainly been somewhat skeptical that we would ever get back to a 0% interest rate world. That was really, really strange that lasted for as long as it did. You could make a pretty good argument for the neutral rate being, I don't know, 2 or 3, kind of, at least, maybe a little more. So, it's just hard to imagine, but I don't know. Crazy things happen all the time. And certainly something on the geopolitical front could cause rates to really plummet and stay down for a period of time. That's happened before. It'll happen again if we wait long enough. So who knows?
That's a really interesting point. Like, I try not to spend too much time looking at macro, but if you look at where the curve is implying the rate cycle troughs out, the Fed officials give you their dot plot of what they expect the neutral rate to be.
Yep.
And
right.
Presumably neutral should mean that that's neither tightening nor easing. So were
That's
they intent on easing, you'd expect the trough to be below neutral, right?
Yep.
Neutral doesn't mean that's where it troughs out. And most of the dots are, in fact, below 3, with 2.5 being the most frequently cited number.
Right.
So, like, something doesn't add up in this. And I think that's been one of the things that has been bizarre to me, like, since the GFC, like when Bernanke and his Fed were saying very clearly, like, rates are going to be low for a very long time. The market kept assuming that we were, like, much closer to when rates would start rising than had actually happened.
Yep, exactly. And yeah, I don't know how to think enough, and I don't think that much about it, but I think some about it. Where, how do things like productivity, population decline, or slow growth, demographics, the aging of society, productivity, how do all those things factor in over the next few years? But yeah, look, I mean, you've just seen a lot of people, a lot of institutions kind of blow themselves up getting this wrong. And that's something I'm just trying really hard to not do, right? It's to just avoid those big mistakes. And easier said than done, but that's the idea.
Are you talking about Silicon Valley Bank there?
Yeah, exactly. I mean, Silicon Valley Bank, investment portfolios, long-term capital management, you name it, right? Where people just take something that seems like it should be obvious, right? Which is, maybe don't go way out on the curve and take a ton of duration risk that you can't afford if things go against you. Maybe don't take on the run, off the run treasuries and play the spread between them and lever it up 100 times. Just stuff like that where it seems so obvious in hindsight, but somehow people talk themselves into it in real time. And I played this game earlier this year in my MBA class with NVIDIA, right? Which, again, I mean, these numbers are slightly subjective, but more or less, if you think U.S. GDP will grow at 2 or 3% a year, which let's all hope it does, you would need NVIDIA by the year 2037, 2038, 2039 to be something like 1% of all U.S. GDP and free cash flow to make a DCF work on the valuation the company had kind of at its peak in whatever it was, March, April, May, earlier this year, which is a pretty astounding number for a company of that size, right? Because it's an amazing company. Don't get me wrong. Like, we should all love to have those kind of problems and those kind of market share numbers and the free, it's not like it's some unprofitable scam. I mean, it's a fantastic world-class company. It's just they're the first to admit that more competition is coming. And you know, how many businesses like that have been truly dominant on a global basis for 10 or 20 years? And nobody's ever generated something like 1% of GDP in free cash flow. But you know, you can shape the narrative however you want, but that was just kind of the math of it, and nobody liked to think about it in those terms for some reason. So
Well, it does beg the Brian Arthur question, right? The increasing returns and the new world of business, where in like the mid 90s, he's like, Microsoft is going to be dominant for a very long time because of like the scale economics of what the computing world does and what big businesses look like.
yeah,
But then, you know, there is always another side to certain elements of it. And even Microsoft had to spend 20 years working off overvaluation at one point while
that's
the business
exactly the
remained
problem. Yep,
dominant. So there
exactly.
is an interplay, and it is wild to see. Like, I mean, I'll say it till I'm blue in the face, but like the large companies can't keep dominating the rest of the stock market as they have over these last 5 years. At some point, they will either be the whole economy, and everything else will cease to exist, or something's got to give at some point.
Yeah, look, I mean, that's another interesting one that people have been chewing up a lot of time on, and I've certainly spent time thinking about it in terms of shaping portfolios and asset allocation, all that kind of fun stuff. And we did a podcast about this, gosh, probably a year and a half ago or
More than
more.
one.
Yeah,
Yeah.
right. Where it was like, all right, what would you rather take? Like, you had to put 100% of your assets into one thing for the next 10 years, and you couldn't make any changes. 100% in the S&P 500 ETF or 100% in the Russell 2000 ETF. And it's a tough one, right? I mean, it really is. I mean, the obvious answer, I think, from our personal bias perspectives would be like, yeah, this probably can't continue. The Russell 2000 is a good bit cheaper in a sense. A lot of unprofitable companies in that index, but overall, like, and you know, the next big companies usually have to come from the current small companies. So you'd think that would work really well. But that's just not how it's worked for a number of years now. And there are arguments in favor of the large caps. And it's a lot tougher debate than it would seem on the surface, I think.
I've definitely started wavering in some of my perspectives there.
Have you?
But yeah, yeah, I still, like I said, I'll say it till I'm blue in the face. But I do think like more of the spread over the last few years is actually fairly explicable.
Hmm.
And I think a lot of the expression that the magnificent companies are overvalued stems from like two in particular having fairly extreme valuations. And, you know, the rest, I'd argue one is probably overvalued, but not like in crazy, crazy terms. And two, I'd say are fairly cheap in the grand scheme of things. So even, you know, on a relative basis, so cheaper than the index and, you know, just not all that expensive given the quality of the businesses and the growth curves, which is, you know, kind of different than I'd premised it all before. That
Hmm.
said, I mean, I still think there are extreme pockets of relative cheapness and small relative to large. And I think, you know, one thing that does strike me is the stratification of like every single way to define quality or to look at margin profiles between large and small companies. Like when things are the same between a large and a small, the large is consistently afforded a considerably higher valuation than the small. And
Mm-hmm.
that tells me there's something structural to like how things are being allocated today, as opposed to anything being different in how a truly objective businessman would value each of these respective businesses.
Yeah, that's probably fair. I mean, and again, I mean, if the answer was you can only fish in one pond and you can pick your own individual investments, I would obviously pick the bigger pond of the Russell 2000 than the S&P 500. And that said, the only new individual investment I've made this year, I think I'd have to stop and make sure I'm not forgetting one, is like a $4 or $5 billion market cap that was a little bit smaller when I bought it, right? So definitely not some giant mega cap S&P 500 company. So I totally agree with your sentiment on that. It's just a tricky one, right? I mean, look, as we all know, the S&P 500 is one hell of a hard bogey to beat if you're actively managing portfolios. So it's just what it is.
Yeah. Yeah. And, one of the other forces that I think is interesting to look at is how this has worked across geographies. Because the strength and the successful performance of large is a uniquely American phenomenon to the degree that it has been. But the stratification between large and small is also persistent across geographies. So, like, if you're looking within Europe, large is done better than small. But if you look at US large versus European large, I mean, it's not even close. And there are all different questions or answers as to why that might be. Dynamism of the European venture economy, right? I thought, if you're interested in that question, I thought the Draghi report on competitiveness was like just a fascinating read. Anyway, I'd say it's worth reading for anyone to like think about some of these questions. But as I'm saying that, maybe Europe wasn't the best example, but that's true in Asia too. So there does seem to be like something fundamentally different with how money's being allocated as opposed to something fundamentally different in what businesses are worth.
Well, that's definitely true. I mean, we've hit on that before in the past, and there was something. Was it Cliff Asness again who wrote something about indexing is kind of the boogeyman here and creating a lot of the problems. Is that who wrote something earlier this? I feel like there was something over the summer.
Very recently, right? Yeah.
Yeah, who ignited that debate again. And yeah, I remember reading it and thinking like, sure, that's definitely a part of the issue. On top of that, you just have this weird, crazy mania amongst like retail / day trading crowds that openly don't care about fundamentals, right? Which is super weird. And something I still just struggle to wrap my head around. And we talked about David Einhorn's contention a while back too, that markets were broken and more inefficient. And I disagreed with big chunks of that argument, and I still do. But yeah, I mean, there's no denying the fact that there's weird stuff going on, and it's a different world than it used to be, and that's always true for sure to a certain extent. But yeah, it just remains. I mean, one thing I definitely agreed with in the Einhorn critiques or thesis was that you can't rely on, I'm buying something, for 30% less than it's quote unquote worth, and it's going to re-rate and grow along the way. So it's going to double over 2 years and we're going to make a lot of money. That's just a tough argument to make on most of the companies that I think those types of investors like to look at. And so for me, it has to be a combination of a business I can understand, a business that I think is at least stable or not falling into its near-term demise, with a management team that I really like and trust to do the right thing. There has to be that element of self-help where something in the management's plans, strategically, financially, capital allocation, something they can control that's going to help drive that return. Because I think you're going to be waiting for Godot if you think I'm buying something because it's too cheap or it should trade higher, or however you want to characterize it. I just think it's going to be brutally difficult.
Yeah, and I would just add, the Einhorn argument, I think where I think it falls short is it was never the best investment strategy to essentially rely on others to give you your return. I mean, that's in a way speculating, even if you
Agreed.
Call it investing. So you always have the option, if a company is well-financed, is free cash flowing, and has an undervalued stock, for that company to just create a lot of value on a per share basis by buying back its own stock, kind of like what Henry Singleton did back in the day. And if you do that enough, there's just no way that the stock price isn't going to respond over time just because of how the math works.
Right.
So in that sense, I don't think you can say the market is broken. I think what's really going on is that investors simply are kind of, we're in a late stage of a lot of trends in the market. So, it used to be that equities and commodities would sort of change in terms of market leadership every decade or whatever the cycles were. And now we've had such a long period of quote unquote compounders and good businesses doing extremely well, that people have become very complacent and not sensitive to valuation. I mean, you can just look at a bunch of examples like Ferrari, which has just a crazy PE multiple relative to the industry and even relative to similar companies, similar brands in the industry. There's plenty of other examples of good businesses
Costco.
that are, yeah, Costco, perfect example. I mean, Costco, great company all around, but it's at a multiple that I think reflects a lot of complacency by investors. And so, I'm curious what you guys think and where you're looking in terms of, what are good places to invest over a 3 to 5 year time horizon. Because if you take a Costco, let's just assume the business is going to keep chugging along, it's going to keep growing, but the multiple could compress by half, and so if the business doubles over 5 years, the multiple compresses, you basically are flat over 5 years, and maybe we have some inflation. So on a real basis, you're kind of losing purchasing power. So for me, just to wrap it up on my end, I think there's a lot of cheap equities in the commodity space, the hard asset space, where we know that demand is going to be increasing over time. I mean, you take something like uranium with the Microsoft announcement of restarting, is it 3 Mile Island, the nuclear plant.
Yep.
And then you got companies that are in that space, very cheap. So I don't have the thesis on uranium, but that's maybe one place. Another place is copper, given the electricity theme associated with AI. So there are ways to kind of align yourself with the trends of the future, but not have to pay up for those.
Yeah, I think that's really interesting. I want to pick on Costco a little more, and then I'll tell you one of the trends of the future that I'm really intrigued by. Costco hasn't even doubled sales over the last 5 years, which is amidst a major NGDP growth rate environment. Stated another way, a major inflationary period. So if they can't double their sales in like the biggest inflationary period of recent times, it's hard to fathom how they could over the next 5 years. So you get that. And, obviously, bottom line grows faster than top line, but not by enough to have doubled over these last 5 years. And then, I feel it's just one of those areas where the lack of volatility has made it really comfortable to own. On the flip side, there are areas that formerly, like I marvel at how semiconductors had, I think that's cracked a little since the summer, had been treated as this non-cyclical area, because part of why Clayton Christensen wrote The Innovator's Dilemma about semiconductors is they are one of the most cyclical areas. The cycles and the cycle of the cycles is so damn fast, and innovation happens so frequently that it was the poster child for making a macro argument about innovation, because things on the micro happen so quickly there. Meanwhile, over these last 5 years, I'd say the life science tools and instruments, that's the area I'd give a call out to, have been trading as like true cyclicals because they're in the middle of their largest cycle ever. Now, this is not investment advice. I just want to caveat, as Phil has, and we do in the podcast anyway. But I think it's an incredibly interesting space. I think it's one where like you have numerous secular growth drivers, and that part is at least easy to understand. You have population growth, you have a growing elderly population, you have a growing middle class in a lot of countries who didn't have true access to medicine before. And then, for the tools in particular, you have this evolution from small molecules. So, like, really, finding a compound that makes something work in the body, to biologics, which is taking like complex biology and scaling it to extract a protein or some specific piece that'll work and make that change. And these companies, like during COVID, you had like two really strong forces that helped the space to a greater degree than had happened before. You had the COVID vaccine itself, which required a lot of picks and shovels in order to be able to manufacture. But you also had a mini VC bubble and that boom that completely unwound as rates went higher. And so all of a sudden, what had formerly been, and what really compounded things, what really made things crazy is, in order to maintain your good graces with the FDA, you have to be able to manufacture your drug on any given day. And when supply chains went crazy, the companies who manufacture these drugs, whether they be the pharma companies themselves or the CDMOs, started hoarding raw materials. So the picks and shovels makers had this explosion in demand, and no one really had a sense of what underlying demand was. So they just kept manufacturing the picks and shovels, and customers kept buying them until suddenly everyone had this realization as supply chains were normalizing, like, whoa, we have way too much stuff. We don't need it all. And so where you are today is these companies are arguably under earning their true steady state earnings, and they are in a really severe, most prolonged downturn for the sector, and the deepest downturn the sector's ever had, to the point where there are some who are questioning whether growth will truly continue going forward at the rate it had before COVID. And I think if you believe that this is an area where growth will continue, even if it is at slightly lower rates than before COVID, it's really compelling because you have these trough earnings with the lowest multiples that have existed in the space in over a decade. So I think that's a really interesting combination. And there are a lot of different kinds of companies that you could look for to kind of fit that vein. So
yeah, that's really interesting. I love looking for things like that where something that's, being something that's temporary is being priced as if it's permanent and vice versa. I think that's one of the better ways to go about finding ideas for sure.
Yeah, and one of I'd add one more wrinkle which I hadn't appreciated, but this stuff tends to be a little more correlated with Fed cycles than I'd ever appreciated. And it's one of the sectors that tends to do best in both short-term and medium-term timeframes coming out of peak rates. So I don't like playing rates, but it's something I didn't realize, and I hadn't realized that it was as correlated to rate regimes as it had been, even if the businesses formerly never had this degree of volatility based on underlying rates. Just funny how the market works that way.
Interesting.
Yeah, it really feels to me like peak pessimism right at a moment when everything should be inflecting in a better direction. And I'd call out. Go ahead. Sorry.
No, I was going to say, if you think it's peak pessimism, it's worth looking at because there aren't very many things in the financial world that seem like they're at peak pessimism right now.
Yeah, there's one other area I was going to call out. I feel like anytime you get these confluence of narratives, you start asking yourself, like, is there something different going on? And the other area, I think, like consumer discretionary companies have been one of the weakest sectors in the last year. There are a ton of companies trading at lower prices and meaningfully lower valuations than they had from pre-COVID to today. I'll throw out some companies that I'll just name a few. I don't own any of these, but I find it interesting that all of them have come down so significantly lately. But like Lululemon, Nike, Starbucks, something like Ulta, something like Elf Beauty, and all these companies have come down so much lately, and it seems like every single one of them, people are concocting narratives about like why this one company is flawed. And yet you could go even wider in consumers. Like I could throw in restaurants. Like, if it's not Chipotle and it's a restaurant, it's probably making multi-year lows, something like Jack in the Box, for example. It just seems like every single company in consumer that's getting beaten down, and most of them are, except for some glorious ones like Costco, um, are uh, are experiencing some degree of like narrative where it's this company's especially troubled right now. But it can't be true that the consumer is broadly weak and every single company is especially troubled right now. Some of these might be wrong, but somewhere in there, there's some baby being thrown out with bathwater. So those are the two big shout outs I give. Go ahead, Phil. Sorry, I jumped back in.
No, that was it. I was just going to say, I think it's really interesting if you can go about finding, if you can find ideas along those lines, it's great. I mean, I don't have any comment on something like Costco particularly. I mean, that's obviously one of my favorite companies of all time. We've talked about it a million times, but yeah, I've always worried about it. Yeah, with the multiple compressing, and I've always been wrong. So, I don't know what's going to change. I will say, look, for the first time ever, you have an outsider in an important role, right? With a CFO who came from Kroger, right? I think that's where he was. That's a pretty big change when you've had one CFO for the entire public life of the company, basically. So, a lot going on there. But look, here's a question I'd put back to both of you then. I think we've kind of played this game before in the past. What kind of over under would you put on the total return of the S&P 500 for the next 5 or 10 years from this point going forward, or maybe both numbers, 5 and 10 years? So I can start, or I can go at the end.
So you want us to set the line here, basically?
Yeah. So I'll set the line, and I guess you guys can then take over under. That'll be easier. So I'd put the over under at the 5-year compounded total return of the S&P 500 at 7% a year, and for 10 years, 6.5%.
So I'd be below that unless we continue to have meaningful inflation. So I kind of would look at it, and this is kind of counter to the prevailing view, where if we have inflation, stocks will go down. But I actually think the reason why equities have been so strong over the last few years is because there has been inflation and at the same time pretty loose monetary policy. And that's a recipe for just everything inflating, and stock prices are, quoted in nominal terms. So on a real basis, I think we're just going to tread water, call it low single digit, 0 to 2% on equities. On a nominal basis, more than that, but it's just hard to know. I mean, I think we are in an environment where inflation is going to continue to be an issue, but it's just understated, with official statistics. I think people misunderstand the Fed stance, really, which I think is very accommodative. And so that's why I'm not at all surprised by how well equities have done. Yeah. And, we'll just have to see what happens going forward. But I don't really anticipate the Fed having any teeth, even though right now maybe it's especially dovish because we have an election coming up, and maybe that's being expressed in the Fed stance right now as well. But yeah, generally speaking, I think investors are too optimistic on what we can expect from equities, especially in real terms.
What about you, Elliot?
So I think you've set a damn fair line for the 5-year. I'd be hard pressed to make a bet on that. I think that's a good line, and I would, for similar reasons to why I think that's a good line, I would take the over on the 10-year. Not by a lot. I don't think I'd bet my whole stash on that, but I think economies compound. And I think there are two things that make me a little more optimistic on the decade ahead than what we've experienced over the last like 15 years. One is I don't think S&P earnings have gone up enough to truly reflect how much NGDP compounded over these last few years.
Hmm.
And I think that's partly because of how much noise we've had from supply chains, from a shift to goods during COVID times, from services, and a shift back to services, and still not finding a true balance. And so you've had like really wonky margin dynamics, including like, way too high shipping and manufacturing rates during COVID for goods, and then way too high labor rates for service companies as you have to rehire, and there's always friction in rehiring. And so one day we'll get to normal and you'll see profits reflect how much NGDP jumped. And then the other thing that I think supports returns from here over the decade, which takes you out into a little longer on my optimism, is, Powell was asked this question during the last press conference, and it's something I've thought about myself. So I'm not just copying Powell's perspective here, but he was asked if rates will ever go back to where they were during COVID and over the prior decade, and he said something to the effect of like, no, those days are gone. Like neutral rates structurally higher now. And when he's saying neutral rates structurally higher, he is saying growth is structurally higher today than it was during that prevailing regime. And it's hard to say exactly where and why it came from. I have some theories, but it does seem like there's a good case to be made about growth being structurally higher today than it was in the past. One of the things I'd point to is maybe we understimulated during the financial crisis and overstimulated during COVID to the point where they balanced each other out. Maybe it's just something like, AI being the first true productivity enhancement out of the internet, right? That was like Krugman's joke about the internet. Like it's not going to achieve any of its promise because we've got no productivity out of it. We haven't. Productivity had actually compressed from the dawn of the internet up till the last few years, and maybe AI changes that. But anyway, truly what I'm doing is just anchoring on what returns have been over the very long term and saying they're going to be that way. And I have to acknowledge the obvious headwind here, which is that if you look at the S&P in aggregate, the PE ratio is on the not just high side, but on the very high side of what's prevailed over the last 100 years. And where I'd say I think the returns come from is one, this step up to NGDP levels of growth and profit terms. But two, I'd say like you could see PE compression at the largest, most expensive companies and see the rest of the index make up for any slippage at the top.
Interesting.
And so, yeah, that's where I'd come at it from. Curious what you think, Phil.
Well, yeah, I set the numbers where they are. I bet I'm at the lower end of the like public, the man on the street perception. I bet most people would take the over on those numbers just because recent history's been well above those numbers. I hope I'm wrong. I mean, I think a lot of it's going to depend on the stuff you mentioned. I'd add productivity in there. Every time we turn around, it seems like there's some new productivity boom that's just waiting to be unleashed upon the world, and the results have been pretty disappointing. I mean, we talked about Bob Gordon's book, The Rise and Fall of American Productivity. It's an age-old debate that's gotten a lot of attention. It's kind of dropped in the last year or two from people's minds, I think. But yeah, I mean, if we can improve per capita productivity by 0.5%, 1%, let alone 2% a year, it makes an enormous difference over a generation or even over 5 or 10 years. And I hope it comes to fruition. I really do, because it would make all the difference in the world. But we'll have to see. I mean, so I think things are priced for more optimism than pessimism right now. So I'm obviously going to take the under if all else is equal, and we'll have to see where it shakes out. I don't know.
Yeah, productivity is a really interesting one. It's something that I've been fascinated by, and did seem like companies made meaningful investments in productivity during COVID, um, with opportunities to make such investment that may have been precluded pre-COVID. Like certain automation initiatives were not very popular with key stakeholders at companies, even though the technology had been there for a long time. And then, with the uh, is it fair to call it a halo now, given what's happened? I don't know a better word for it, but with the halo of COVID, some companies were able to make investments in automation that these stakeholders would have opposed. But we haven't like truly seen the benefits of that yet. But those are the kind of benefits that kind of scale as these businesses continue to grow.
Right.
And then AI, right? Like it has to help productivity at some point.
Yeah, the front of the journal or the special section of the Wall Street Journal this morning had a line about, all technology tends to get overestimated in the short run and underestimated in the long run. So it was about the impact on AI of our life and productivity and all that kind of good stuff. And it'll be gradual but profound. And that seems like a pretty fair way to put it, right? I mean, some form of AI has been around for decades already. It's getting lots of attention and buzz right now. Like, I don't know. I'm a little skeptical. I'm always been in the camp that like electricity and running water and penicillin were a lot bigger deal than chat GPT or, whatever's happening right now. I'm not diminishing it. The information economy has continued to unleash human potential in massive quantities, and that's a good thing. And I certainly hope it'll continue, but I don't think it's going to be like a 6-for-1 improvement in GDP per capita like it was if you were born, in the 1920s or 30s or 40s. I think it'll be far lower than that, unfortunately.
Yeah, I'm kind of curious how you actually measure a lot of this, because AI, to me, it will be very significant. I think there's an exponential curve here to how AI is improving. But what will it do to equity values, let's say? I mean, it can lead to a lot higher productivity, but in my mind, it also could really crush a lot of equity values. Especially in the world of ones and zeros, where if AI can just write software and come up with um, you know the solutions you would need, like let's say CRM. I get it that a lot of these things are mission critical, they're installed, there's a sales forces driving these things, but the cannibalization always starts on the margin, like we've seen with self-serve SaaS software. Maybe small businesses get into it first, but over time, if the cost advantage is compelling enough, it does affect the companies that thought they were immune because they had huge sales forces and so forth. So I think the impact on equity values is really hard to gauge. Right now, I think if you're really in the weeds, you can make the argument that AI is going to make these companies even more profitable because they can kind of improve their products very cheaply. But to me, isn't that a little bit like the Buffett tippy toes analogy in the, back in the textile industry where,
Yeah.
you're kind of everybody has to install that latest improvement. And in the end, everyone's standing on their tippy toes, and no one's seeing better, but everybody is miserable. And I feel like we've already seen this in some industries in the past that are kind of analogous, and maybe AI will surprise folks in terms of what it does to certain equity values.
Oh, let me ask you this, John, to kind of like help shape it. But do you think these profit pools just go away, or do you think they're shifting?
Well, I feel like some of them are going away. I mean, let's say right now, just a snapshot in the moment, and this is what Peter Thiel said at the All In conference, that basically NVIDIA is currently capturing more than 100% of the AI profit pool, because the entire rest of the AI space is actually losing money. So clearly that's going to change over time as the space matures. But, if CRM software can be created at basically zero cost by AI, then where's the profit pool in CRM software? It's just going to be competed away. And the benefit accrues to the customer. And, that's kind of how capitalism works. So I think this is going to have great, value creation for the customer, where the impact may be much more diffuse. You may not really notice it when every S&P 500 company saves on their CRM software, but you will obviously see it in potentially crushed market valuations of CRM software providers. So in that sense, it does get shifted around. And look, some companies are going to be very successful in actually making more money because of AI. But I don't think you can apply that rationale across the board. So, when back in the day when those companies came out, that they were doing the daily deals, what was like the big one, Groupon?
Yeah.
There were no barriers to entry, and it just, there was no sustainable business there. And I think AI is creating a lot more competition for companies that deal in ones and zeros, like, for example, gaming, right? I mean, AI can create games or help create games. So it may not be just that AI does everything, but it's going to make like a 5-person shop. You've got 5 really good gaming developers, and they're leveraging AI. They may create a game that's competitive with some really big games. And so you could have like just a lot more titles being released all the time. And so that basically attention gets spread over a lot more games that are created cheaply than just the top games. Kind of like when on TV, instead of just having, the networks, you had like tons of choice through cable and then the internet. And so then the 3 networks just captured a lot less of the value.
It's an interesting analogy. I kind of agree with that.
I mean, maybe to think through the other side, couldn't this end up benefiting the incumbents tremendously? Where from the software to the gaming example, really all you're doing is drastically reducing their costs, and they're able to still churn out a high quality product.
Well,
so they
I mean,
invest less in it.
When you drastically reduce the cost, I think then there's a lag, but at some point that's going to get reflected in how those games are priced. Because one of those, let's say there are 5 big gaming companies. Is that the example you were using, Elliot?
Yeah, or CRM, right?
Or
Can't they just hire
CRM,
less developers and
Yeah, and let's say there's like 3 or 5 big CRM providers, right? And they all drastically reduce their costs. Well, one of them might decide, I'm going to pass some of that on to my customers to get market share. And so it just becomes, see how they lose pricing power in that scenario? And pricing starts a downward spiral.
I do. I guess it depends how willing. So yeah, I could absolutely see how that would put pressure. I guess it's harder for me to fathom a company trying to do it themselves. So you would need competitors to come in and be like, I'm going to create something completely different using AI at a much lower cost and pass on those savings to you.
Yeah, and I mean, venture funding is abundant. I'm sure there's startups being funded right now that are going to use AI to deliver these kinds of products much more cheaply. And that's going to just impact pricing. It's going to impact market share. I don't see how it doesn't.
Yeah, I mean, one clear takeaway from this for me, because there's a lot of things that I just can't know, is that you got to be really sure you're not going to get run over, right? With all this change and all this ability to compete. So, like, the demise of capitalism, I think, has been greatly exaggerated. The creative destruction that we're going to see. Like, I wouldn't want to be on the losing end of one of these bets, whether it's a great company like Costco or some, very speculative startup that's just going to get completely blown out of the water before it ever gets a chance to get going.
Yeah, and people use this. I hear a lot about mission critical installed base, Salesforce and stuff. But remember the company Computer Associates back in the day, CA? I mean, they
Of
were
course
like,
I do. I'm from Long Island.
yeah,
Charles Wang ruined my Islanders.
yeah. I mean, weren't they like supposed to be so embedded that the switching costs were just incredibly prohibitive and they were gonna cash flow forever?
Yeah, but did you ever read Financial Shenanigans by Howard Shillett?
Yeah, there was obviously, accounting.
A great
They
book.
were the only company that checked all 7 boxes of fraud.
Yeah.
Only
Yes.
one. They were truly special.
Right.
I mean, it's easy to make that case when everything's just a fiction.
Yeah, but I mean, they did have their software in those customers, right? That's probably not the best example. I'll grant you that.
And they did have value too. They sold for considerable value. How about IBM? IBM's really funny to me. Like, did you ever think we'd end up in a day where IBM has a considerably higher multiple than Google and is benefiting more from AI than Google? But yeah, use that one, John, instead.
Yeah, I mean, the point is no one really knows, right? But investors are valuing these companies as if they do know. I mean, these are basically, the problem is it's so seductive to look in the rear view mirror and to just keep betting on a company that's delivered, like Constellation Software, right? Great company, well run, but are investors being seduced by the past? And what does AI do to a model like Constellation Software, where Constellation Software isn't going to be a leader in AI? So are there other companies going to come up and start nibbling at their, customers? And if they do, then all that needs to happen is just that you lose your pricing power. And then over time, the business model just isn't as attractive as it has been.
Yeah, I think that's an interesting, like, you could ask yourself, like, what are industries where AI might change the dynamics of how they build product and go to market, and like list out all the industries where it might hurt and where it might benefit. Like, part of my plug for life sciences that I didn't say is that the whole space has suffered from a inability to analyze massive troves of data, and then suddenly you turn AI on, and well, you just need more picks and shovels once the success and probability of success goes up of drug development. And then with software, it's like the barriers to entry just got cut to zero for creating new software in any vertical. And it might not work right away, but over the very long term, even if you're able to defend your presence today for quite a while, it's going to be flipped on its head at some point. I think, John, you had a really interesting point with extrapolating the past successes of these companies, because I do feel like what part of, back to what we've been saying about the market generally, I feel like one of the things that's been happening lately is every second derivative is getting extracted into perpetuity, whether they be good or bad. And so when things are good, they're great, and when things are bad, they're terrible. And the longer bad lasts for, the worse it gets and whatnot, even if the underlying business reality isn't really changing all that much. I feel like that's been one of my frustrations with this environment in general. And I guess AI is just one more one more curveball that we all have to deal with in that sense.
Yeah, I mean, go ahead, Phil.
I was gonna say, I do think it's a curveball, but I don't know. Like, I'm trying to take a broader view of it. I mean, there's been lots of technological curveballs along the way, right? I mean, I think everything from, like I said, or indoor plumbing and electricity to modern drugs to the telephone to the internet to now whatever you want to call it, AI, are kind of variations of the same thing, right? So we just have to navigate it, right? I mean, it is a curveball, but life's full of curveballs, and this is just one more example of it, I think.
Absolutely.
Yeah, I would just say, not it's different this time because I hate saying that, but what I do think is maybe a little bit unique now is that, with AI, we are potentially getting something that's smarter than we are, where it just becomes more difficult for us to predict what the end game looks like with the kind of exponential improvement that's going on. I mean, there are credible people who view AI as potentially an existential threat to humanity. And if it's anything close to being that, then obviously it can also be an existential threat to companies, especially companies that are, digitally based. So just to get back to the investing part, I want to be where I am fairly certain that AI isn't going to kill margins or create, a million of the same product that I am selling. And so when I think of copper, for example, I know we're going to need more copper in the future. In an AI future where we need more electricity, we're going to need more copper. And AI cannot just create copper out of thin air. And I don't see a path to where it can do that ever. So to me, that is a more prudent way of kind of wealth protection and growing your wealth over time than investing in a CRM software company at like 10 times sales.
Yeah. I mean, all I would add to that conversation is I would just want to make sure that the copper company management wasn't lining its own pockets and was actually doing things that were in the best interest of long-term ongoing shareholders. Because I've just seen, and again, I've kind of bowed out of that energy materials sector for 10 plus years, but I've just seen too many horror stories over the years of companies in that sector for whatever reason that just they were completely at odds with the incentives that you would hope that would be demonstrated by companies acting in the interest of their long-term shareholders. So, but I agree with you. Look, I've heard several people in the last year or two kind of defending their thesis or pitching me on their thesis of exactly what you just described, John. And I don't have any logical holes to poke in it.
Yeah, I think management is crucial in any kind of real asset space. I think, alignment, capital allocation, all those good things matter a ton. And, that's why, you really got to be careful and know who you're investing with.
Agreed.
All right. Elliot, any last words before we wrap it up?
This has been a lot of fun.
Yeah, it was good to be back with you guys. It really was.
Thanks for being here, Phil. I know you, just for our listeners, not going to be this isn't going to be a regular thing again, but we do hope that you'll rejoin occasionally in
Likewise,
the future.
yeah, this was always the goal, was to pop in occasionally, and I hope to keep that up if you guys will have me.
Absolutely.
Always welcome, man. This was a lot of fun, as I said, and I'm happy we got to do this again.
Thank you all for listening. Goodbye for now.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.